Hello everyone, welcome to the 171st episode of me learning how to trade in Forex. So in the last episode we went through evaluating a company's management. Technically, so a company is a legal entity that exists independently from its staff, but the people that run the company, their skills and personalities play a huge role in its success or failure. So we should find out who is currently leading the company and assess whether it's in good hands. So to do that, we first vet the executive team. So internet has plenty of information about the people at the top level of the company. So here's some questions it should be able to answer. What is the educational background of each executive? Where have they worked previously? What relevant experiences do they bring to their role? And have they had any notable achievements or failures previously? So using the answers from that, we could be able to build up a picture of the team's key strengths, weaknesses and general capabilities. And then we could quiz the management, so find out more about the company directly from its senior management team through conference calls, which are usually held following a release of quarterly or full year financial results. So we can normally find the archive of transcripts or recordings of these conference calls, along with all the company's recent financial results in the investors relations area of the company's corporate website. And we've got to gauge the management confidence. So the management team should really know how a company is doing. So the level of confidence these individuals demonstrate in the business can be very revealing. So naturally, their public statements will tend to be framed in positive terms. But is this reflected in their behavior behind the scenes? So specifically, are they increasing or reducing their stakes in the company? As senior executives are typically remunerated, at least in part, with stocks and options. So this incentivizes them to make decisions that benefit the business, since their own personal wealth depends on its growth and success. But when management team are seen to be selling their stocks options, this may indicate a lack of confidence in the company or a negative view of its future prospects. So got to be aware of that. Look at management history. So a strong business steered by a group of skilled individuals can still founder if these people fail to work together properly as a team, or if the organisation doesn't provide the right environment for them to flourish. So if a series of senior executives have left in quick succession, this could point to weakness in the company's culture or troubled relationships in the management team. So this is also the same as seeing a senior post being filled several times within a short period. When management issues does appear to exist, often wise for investors to steer clear of the company no matter how good the underlying business model seems to be. And we review the corporate governance. So each company will have its own corporate governance policy, defining the relationship between management, directors and stakeholders. So that corporate governance policy is there as a safeguard to make sure the proper procedures are followed and to help prevent improprieties. So it's important to take a look at it. And it's likely to include information on the board of directors, stakeholder rights and takeover defences. And then we went through the lesson summary. So now we're on to understanding balance sheets. So understanding balance sheets. 19/6/2024. So far, your analysis of an individual company has enabled you to build up a general picture of the business, the way it's run and its state of health. The final step is to carry out a detailed review of the company's finances. This may take a bit of time and effort, but it's worth doing. Financial statements can yield all sorts of interesting quantitative data from which you can deduce the strength of the company, the effectiveness of its strategy and the prospects and its prospect for the future. By carrying out a detailed review of the company's finances, you can obtain interesting quantitative data from which you can deduce the strength of the company, the effectiveness of its strategy, and its prospects for the future. So what should you look for in a financial statements, and how do you interpret the figures you see? In this lesson and the two that follow, we'll run through some key areas you should include in your analysis and explain what they mean. So what is a balance sheet? A balance sheet is a statement of the company's assets, liabilities and capital at the end of a particular reporting period. It typically includes, a balance sheet is a statement of the company's assets, liabilities and capital at the end of a particular reporting period. It typically includes assets, so cash, the most liquid assets, which also include any government debt being held. So the most liquid assets, which also include any government debt being held. Marketable securities, marketable securities. So equity and debt securities that can be traded on a liquid market. Equity and debt securities that can be traded on a liquid market. Long-term securities. So securities which can't be liquidated immediately. Securities which can't be liquidated immediately. Inventory. Goods available for sale, typically valued at their cost or market price, whichever is lower. Inventory. Goods available for sale, typically valued at their market price, at their cost or market price, whichever is lower. Accounts receivable. Money owed to the company by its customers, factoring any expectation of money unlikely to be paid. Money owed to the company by its customers, factoring any expectation of money unlikely to be paid. Factor in any money that is unlikely to be paid. Expectation of money that is unlikely to be paid. Fixed assets. These include land, equipment and machinery. So include land, equipment, machinery. Intangible assets, non-physical assets such as intellectual property. Tangible assets, non-physical assets such as intellectual property. Oh my god, that intellectual. Intellectual property. Liabilities. Long-term debt, the interest and principal on corporate bonds that the company has issued. Long-term debt, the interest and principal on corporate bonds that the company has issued. Tax payable, taxes that will have to be paid off, although not immediately. Taxes that will have to be paid off, although not immediately. Pension funds, money set aside to provide for employee pensions. Pension funds, money set aside to provide for employee pensions. Shareholder equity, shares, the equal parts into which the company's capital is divided, with their owners being entitled to a proportion of the profits made by the business. The equal parts into which the company's capital is divided, with their owners being entitled to a proportion of the profits made by the business. With their owners being entitled to a proportion of the company's profits. Don't know why I just went caps there. Company's profits. Retained earnings. Earnings that are subsequently invested in the business or used to pay off existing company debt. Earnings that are subsequently reinvested in the business or used to pay off existing company debt. Treasury shares. Shares which are set aside to be used at a later date if the company needs to raise funds. This can also be referred to shares that the company has brought back. So shares which are set aside to be used at a later date if the company needs to raise can also refer to shares that the company has brought back. The best way to interpret a balance sheet is to compare it with previous releases, looking to see which way the figures have been changing over time. Best way to interpret a balance sheet is to compare it with previous releases, looking to see which way the figures have been changing over time, seeing which direction the figures have changed over time. You might also want to review it alongside a balance sheet for other similar companies within the industry to get a sense of what's the norm. Review it also with similar companies' balance sheet. Within the industry. To see what's the norm. What's normal, basically. From a balance sheet, you can derive a number of useful ratios, such as the popular debt-equity ratio. This measures a company's financial leverage. To find it, you divide a company's liabilities by its shareholder equity. Imagine you're analysing the financial statement of oil company B. The company's latest balance sheet is shown below, simplified for clarity. Cash and cash equivalents, inventory, other current assets, long-term securities, fixed assets, intangible assets, inventory. Total 261.8 mil. Liabilities, current liabilities, long-term debt, other liabilities 164.6 mil. Shareholder equity, retained earnings nil, treasury shares nil, total shareholder equity 97.2 mil, total 97.2 mil. How would you calculate the company's financial leverage? So financial leverage, debt divided by equity. So debt is its liabilities, isn't it? So 164.6 divided by its equity, so that's its shares, 97.2. Divide the company's total liabilities by its total shareholder equity to get the debt to equity ratio. A debt to equity ratio of around 20% will be considered low, whereas a figure of over 100 is high, so oil company B has a considerable amount of debt. The balance sheet can be used to derive useful ratios, such as the debt equity ratio, which measures the company's financial leverage. Debt to equity ratio is calculated equals liabilities over its equity. So liabilities over its equity. So a debt to equity ratio, a debt equity ratio of around 20% will be considered low. A debt / equity ratio of over 100% would be considered high. Now, you suppose you discover that oil company B has a higher debt equity ratio than its competitors. What might this imply about a company's strategy? Higher debt equity ratio, an aggressive approach with a higher level of risk, a cautious approach with a lower level of risk. I think it's an aggressive approach because I don't really know how to explain it, to be honest. A lot of the company itself is owned by other people, if that makes sense, because debt is something you own to others, and equity, you're giving out part of your company to shareholders, so a lot of your company is owned by other people. So it's risky because you're relying on others funding to develop your own company, right? A high ratio would indicate that the company is financing ambitious growth plans. If these come to fruition, shareholders could reap the rewards. However, in the meantime, the company will be liable for greater interest expenses and exposed to higher risk, potentially even making it likely to fail and go out of business. A high ratio could indicate that companies financing ambitious growth plans. If these come to fruition, shareholders could reap the rewards. However, in the meantime, the company will be liable for greater interest expenses and exposed to higher risk, potentially even making it likely to fail and go out of business. A high equity ratio could indicate that the company is financing ambitious growth plan. However, in the meantime, the company will be liable for greater interest expenses. Will be liable for greater interest expenses and exposed to higher risk. Potentially even making it likely to fail and go out of business. Potentially even making it likely to fail and go out of business. Right, okay, so let's summary then. Balance sheet is a statement of a company's assets, liabilities and capital at the end of a particular reporting period. From the balance sheet you can derive useful ratios such as a debt-equity ratio, which measures financial leverage. You can calculate the debt-equity ratio by dividing the company's liabilities by its shareholder equity. A high debt-equity ratio implies an aggressive strategy with potentially high risk. An aggressive strategy with potentially higher risk. An aggressive strategy with potentially higher risk. Analysing cash flow statements. Analysing cash flow statements. So 19/06/2024. In this lesson we'll take a look at another key area of the financial statements to consider in your fundamental analysis, the cash flow statement. This is a record of the cash generated and used by the company. So the cash flow statement is a record of the cash generated and used by the company. Unlike the balance sheet, which is a snapshot of a particular point in time, the cash flow statement covers a certain period specified by the company. So the cash flow statement covers a certain period specified by the company. Balance sheet is a snapshot of a particular point in time. You usually see data listed under the following categories. The cash flow statement has the following categories. Cash from operations. The money generated by the company's normal business operations is shown here. Sometimes it can be further broken down into earnings additional to cash, subtractions to cash. So the money generated by the company's normal business operations can be further broken down into earnings addition to cash, subtractions to cash. The figure is significant because it can indicate whether the company is able to make enough money to maintain and develop its operations, or if it has to rely on external financing. So this figure is important as it can indicate whether the company is able to make enough money to maintain and develop its operations, or if it has to rely on external financing. Cash from investing. This reports the company's sales or purchases of long-term investments, properties and equipments. The company's sales or purchases of long-term investments, property and equipment. Cash from financing. Here you see details of the company's corporate bonds and shares that have been issued or repurchased. Dividend payments to shareholders also be listed. Company's corporate bonds and shares that have been issued or repurchased. Dividend payments to shareholders are also listed here. Cash flow statement. Operations, investing, financing. So cash from operations, cash from investing, cash from financing. So what can we learn from these figures? Well, as the saying goes, cash is king. Many analysts feel that cash in the bank is an important asset, particularly because it's something that can't be faked by clever accounting. The bottom line is that if the company is consistently generating more money than it's using, it will potentially be able to do a number of useful things with the surplus, such as increasing its dividend payments benefiting shareholders, pay off existing debts reducing its expenditure on interest payments, repurchase shares which can have multiple benefits. If a company is consistently generating more money than it's using, it can use the surplus to do useful things such as increase its dividends payments which benefit the shareholders, pay off existing debts, reducing its expenditure on interest payments, pay off existing debts which reduces its expenditure on interest payments, repurchase shares which can have multiple benefits, repurchase shares which can have multiple benefits. So that means, I think the benefit there is to like reducing the supply out there in the market. So if you're reducing the supply but the demand stays the same, then that means the share price is going to go up. So the company can get more money from its shares, right? Did you know a company might choose to repurchase shares for a variety of... Oh, here we go. Here's a reason. Repurchase shares for a variety of reasons. Reduce the number of shares owned by private investors, lowers the amount that must be paid out in dividends. The money saved can then be used to strengthen the business. If the company feels the market has undervalued its business, it might buy back the shares to take advantage of this, possibly reissuing them once the price is corrected. Reducing the number of shares in circulation helps boost certain ratios that are commonly scrutinized by the markets, such as earnings per share. The announcements of an upcoming buyback sometimes causes short-term investors to flock to the stock concerned, in the hope that the improved ratios will trigger a rise in the share price. These are reducing the number of shares owned by private investors, reducing the number of shares owned by lowers the amount that must be paid out in dividends, reduces the amount which must be paid out in dividends. The money saved can then be used to strengthen the business. The money saved can then be used to strengthen the business. If the company feels the market has undervalued its business, so thinking that the business is actually worth less than what it should be, it might buy back the shares to take advantage of this, so buying it back at a cheaper price, possibly reissuing them once the price is corrected, so once the price has gone up again. So buy low, sell high, basically. If the company feels the market has undervalued its business, it might buy back the shares to take advantage of this. It might buy back the shares cheaper to take advantage of this. Possibly reissuing them once the price has corrected. So i.e. buy low, sell high. Reducing the number of shares in circulation helps boost certain ratios that are commonly scrutinized by the markets, such as the earnings per share. Boost certain earnings per share. So if there's less shares in the market, then that means the company can pay out less in dividends. No, wait. No. It doesn't have to reduce its share. So, for example, if there's £100 worth of dividends to be paid out, and there's 10 investors, each holding 10 shares. No, that's a really bad example. Let me think again. So if there's £100 worth of dividends that have to be paid out, and there's 100 people, each one of them having one share, then each person gets £1. So their earnings per share is £1 per share. But if you only have 10 people, oh no, if there's only 10 shares that goes around, but you still get, but there's still that £100 worth of dividends, that means the earnings per share is going to be increased from £1 to £10 per share, because there's only 10 shares going around, there's only going to be 10 people that's going to be able to receive dividends, and since the dividend is still £100, then the earnings per share will be 100 divided by 10 instead of 100 divided by 1. So your earnings per share is going to increase, which is going to attract the investors to come invest in that share. So yeah, so if there's more investors coming in to try to buy that share, that increases the demand for that share, and since the supply hasn't changed, then the share price is going to go up. Reducing the number of shares in circulation helps boost certain ratios that are commonly scrutinized in the markets, such as earnings per share. The announcement of an upcoming buyback sometimes causes short-term investors to flock to the stock concerned in the hope that the improved ratios will trigger a rise in the share price. The announcement of a buyback sometimes causes short-term investors to flock to the stock concerned, to gather to the stock concerned in the hope that the improved ratios will trigger a rise in the share price. In the hope that the improved ratios will trigger a rise in the share price. You might want to compare cash from operations with net income, discussed in the next lesson. If the cash figure is higher, the company can be said to have higher quality earnings. In other words, a substantial proportion of the earnings from business is being turned into cash. On the other hand, if cash from operations is dwarfed by the net income, you might compare the company to a friend who takes home a generous salary each month, yet never seems to have the cash to buy a pint. Where is all that money going to, and why? Unless there's a valid reason for the difference, it may imply that the company is operating inefficiently. So, cash from operations could be compared with net income. If cash figure is higher, the company can be said to have high quality earnings. In other words, a substantial proportion of the earnings from the business is being turned into cash. So a substantial proportion of the earnings from the business is turned into cash. If cash from operations is dwarfed by net income, however, if net income is higher, it shows the company is earning a lot of cash but is short on it. Where has all that money gone to and why? Unless there is a valid reason for the difference, it may imply the company is operating inefficiently. It may imply the company is operating inefficiently. So they're not spending their money in a wise way, basically. Right? However, if net income is higher. So let's a summary. A cash flow statement records the cash generated and used by the company, shows details across a period of time specified by the company. Fundamentally, the cash flow statement tells you whether the company is consistently generating more money than it's using. If cash from operations exceeds net income, the company is said to have high quality earnings, implying it's operating efficiently. Fundamentally, the cash flow statement tells you whether a company is consistently generating more money than it's using. Cool. So I'm going to leave this episode here then. Thank you all for watching, and I'll see you guys in the next video. Bye bye.